British house prices fell unexpectedly last month. Welcome to Market Insight, I'm Ramzan Karamali. Mortgage lender Nationwide said that house prices fell for a second month in a row in April. Other data out today in the UK showed factories slipped back into a downturn as cost pressures rise. So what does this all mean for policymakers at the Bank of England as they gear up for their meeting next week? Well, to help answer that and more, I'm joined by Hetal Mehta, Head of Economic Research at St James's Place. Hetal, thanks so much for joining us. So first of all, what do you make of this unexpected fall in house prices?
I'm not going to read too much into this dip. We've seen a number of indicators picking up recently. Mortgage approvals are trending up. New buyer inquiries, when we look at the RICS survey, are also picking up. Probably a bit of noise, bit of interest rates picking up, mortgage rates, picking up slightly, maybe having a marginal effect. But I think the fundamentals for the UK housing market are still looking much better than they were a year ago.
Manufacturing in the UK, on the face of it, looks pretty weak after today's PMI data, especially as cost pressures increased at their fastest pace in over a year. Do you think this could have an impact on the Bank of England's rate decision next week, or are we still looking at later this year for a rate cut?
So I think with the manufacturing PMI, putting it in a global context, manufacturing everywhere has been under pressure. It doesn't help the Chinese economy, which is, clearly central to the manufacturing sector, has been weak. So I think the fact that we've seen the UK numbers look weak isn't something that is too worrying. Remember, we had the very, very mild recession in the second half of last year, and the other economic indicators do look like we're starting to pick up. And I think when you look at the broader economy, things like credit conditions that are improving is actually quite positive. And the services sector is still much bigger for the UK than manufacturing.
Well, turning to Europe now, and yesterday we got some GDP data out which suggests there seems to be some signs of recovery. Do you think this can be sustained?
I think that a gradual recovery in Europe is likely. The inflation picture is getting better. It looks like the ECB is on course to cut interest rates within the next few months, and that will start supporting economic activity. Again, we had a mild recession in the second half of last year, and things seem to be getting slowly better there as well.
Now, you mentioned there the ECB. Most economists are expecting a cut in June. We had inflation data which seems to show that it is stabilising across the Eurozone. But so what happens after June if they do cut then?
I think there's a really big question mark around the pace of easing, particularly when you look at inflation in the US, which has been trending up. UK inflation is quite high. It's very difficult for the central banks to be too far apart in terms of their policy cycles, and for the ECB in particular, if they do cut in June, there's going to be a big question around how far ahead of the Fed they are, and the currency implications of that. So I think it'll be very much meeting by meeting. If the Fed hasn't cut by September, then I think that puts the ECB in a tricky spot, and they may have to skip a September cut and just wait and see. And commodity prices picking up is going to feed a bit into higher inflation, so the ECB will be mindful of that too.
Well, obviously the big event is tonight with the Fed. We're unlikely to see a rate cut, but what commentary would you like to hear from Jerome Powell?
Well, I think just understanding the Fed is still keeping all options open will be important. There's been clearly some chatter about a rate hike given the recent trajectory of inflation. I think that's most likely overdone. One thing that people need to bear in mind is that the timing of the US election really does complicate the picture somewhat. So I think it's going to be a case of they've got a watching brief. They probably don't want to hold on to the dot plot that they published back in March. There isn't going to be a fresh dot plot today, but that does seem out of date in that 3 cuts was the central expectation last time, and that's just not viable in the face of the current inflation trajectory. So I think Powell really needs to make the point clearly that they are taking note of inflation picking up and just what their reaction function is to the latest data.
Hetal Mehta from St James's Place, as always, many thanks for your thoughts. And that's Market Insight. Don't forget you can watch more videos on Reuters.com.